Okay, so we said we sometimes we might have cases where we have a specified asset, we are selling the specified asset, and we are going to suffer capital gains tax, but the asset is jointly owned. In cases where we have a marriage in a community of property, that means we jointly own every asset. So what we do in such cases, who is liable to pay tax. So the procedure is we calculate the capital gains on the asset the normal way, then we apportion the capital gain to the spouses in the ratio of their interest in that asset. So normally it will be 50-50, but if you agree that normally for a marriage it will be 50-50, but sometimes it might be a partnership that is selling an asset. And I am partnering with Romeo, and I have 95%, and Romeo is 5%. So we share in that ratio. That is what you do for assets that are jointly owned. Okay, now let's cover shares. Shares are also market specified assets, because we say a specified asset, those are immovables, marketable securities, and what do we call them? And intangibles. So we only assess unlisted shares for capital gains. So we don't really account for capital gains on listed shares. That's why we only have what we call capital gains withholding tax of 1%. So it is also not important to distinguish a bonus issue from a rights issue for listed security, because subject to a 1% capital gains withholding tax. That is taxation of bonus and rights issue for listed security is the same. So we have a way we treat bonus issues and rights issues. Uh, a rights issue is just treated as an improvement. We know that how we treat improvements, isn't it? Also claiming inflation allowance, exactly how we do when we are accounting for improvements. But bonus is a little bit different. We have to calculate the new cost and all that we'll see in the next slides. But if we are talking about listed securities, whether it's debentures or it's shares, there is no need to distinguish between a bonus issue and a rights issue, because we really don't do the capital gain calculation. What we do is just to calculate 1% of the 1% of the gross capital amount, and that will be withholding tax, not a capital gains tax. Okay, now let's cover bonus issue. A bonus issue is an addition at no cost. The full sale consideration received on the disposal of the bonus shares be will be capital gained. Yes, this statement is good. The full sale consideration received on the disposal of bonus shares will be capital gain, because we don't have any deductions that are deductible against the bonus issue, because we issued at no cost. So even if we think about inflation allowance, we allow it on the cost or on the improvements. In this case, we issued at no cost, or we were given the bonus shares at no cost. Therefore, the full sale consideration will be a capital gain. Capital gains tax is only triggered by the disposal of the bonus shares. Effectively, a bonus issue results in the dilution of the base cost of the total shares, and hence we calculate new cost per share when there is a bonus issue. Okay, that is what I was saying. You see how we calculate new cost per share. Okay, so that means if maybe initially we had issued 10,000, uh, who is joining this late. Next time I won't be allowing people. I'm telling you. Okay. So I was saying, let's say initially you acquired 10,000 shares at $2 each. That means the total cost of the shares were 20,000, was 20,000, isn't it? Then you are given another 5,000 shares, bonus shares. That means effectively we now have 15,000 shares, but the cost is still $2 per share. So to calculate the new cost, you would say the $20,000 divided by 15,000 shares. That means now the new cost is now $33, of which originally we had acquired the original shares at $2. Okay, so that is the dilution that we're talking about. Um, so number five is saying the new cost per share is used to calculate the original cost of the share disposed if a portion of the shares are sold. So why is it important to calculate the new base cost when we have a bonus issue? So that when we subsequently sell, maybe partially sell the shares, we can now calculate the original cost of those shares disposed. Maybe out of those 15 shares that we have now, maybe we dispose 8,000. So the question is, what will be the cost of those 8,000 shares? And the answer is, we will just say 8,000 shares multiplied by the dollar 13 that was our new cost. That means these shares would have cost us 10,667. That is 1.3 multiplied by 8,000. Okay, so that is why it is important to calculate the new cost after a bonus issue. What about rights issue? Rights shares are issued at cost, therefore they are an improvement. Inflation allowance is granted uh, backdated to date of original shares were acquired. Okay, so even if we have a rights issue, the inflation allowance we will count the days from when we originally acquire the shares. Okay, this is the number. Kudakwa bought for 500 shares of dollar each in a company listed on the Zimbabwe Stock Exchange in 2009. Here, let's just put 2017. In 2020, the company issued a bonus issue of two shares for every three held. Kudakwa sold all his shares in this company on 20 October 2021 for $50 each. Calculate Kudakwa tax liability or refund. Okay. So what do we do then? We say, okay, the original share costed us how much? 4,500 multiplied by dollar. That means $4,500. What about the bonus issue? We're given two for every three. So if you say 2 over 3 multiplied by 4,500, that means our bonus shares were 3,000. Okay. So what is the new cost now? We are going to say the 3,000, our bonus shares plus the shares that we had, which is 4,500. Now we have saved 500 shares. Then we divide by $4,500, and our new cost will be 60 cents. Okay, so our new cost is now 60 cents. When we subsequently sell these shares, we are going to say what is the total, the gross capital amount will be, of course, 45,000, no, the 7,500, which is the total cost. Uh-huh, uh-huh. No, it's 4.5 divided by 7.5. It's the other way around. All right. Okay, so when we are now calculating the tax liability, we are going to say, uh, okay, uh, we have a bridge. Our days are bridging the D $10 date. So normally we just say 7.5, which is the number of shares multiplied by $50. 7,500 multiplied by $50, it will be 11,250. Then we just multiply by 5%, because that's what we do, isn't it? It was acquired in between dollarization and de-dollarization, and was sold after dollarization. So in this case, we just calculate 5%. But for the sake of learning, if we compute our CGT in a normal way, we are going to say 7,500, new shares, total shares that we have. Then we multiply this by $50. Then we have 11,250 is our gross capital amount. So what do we deduct from gross capital amount? We deduct exemptions. There is no recoupment on shares because we don't allow capital allowances on shares. Okay. So then we say less allowable deduction. We under the allowable deductions we have the costs, and the cost will just be 7,500 multiplied by the 60 cents now, and it goes back to 4,500, our original cost of the original shares. Then the inflation allowance now, it will just be 4,500 multiplied by 0.025, which is 2%, multiplied by. The question is, how many years are we going to count there? Are we going to count separately for the original shares and also for the bonus share? The answer is no. We count from the date when the original shares were acquired. So we acquired the original shares in 2017. So we say 2017, 2018, 2019, 2020, 2021, we have 5 years there. Then we multiply by 5 years. That is how calculate how we get our inflation allowance. Then everything will be smooth from there. So that is how we do our our capital gain. So we have shares purchased. The solution now. It was acquired in 2019 for 500. The bonus was 2 over a. That's 3,000. Uh, I was not doing an Excel screen. Okay, I was doing. All right. Wanayo. That's a very good observation. Okay, so we only have without index of 1%. So at least we are one source listening. Okay, so our 7,500 multiplied by $50, then we have 11,250. Then we multiply by 1% because these shares are listed. So the capital gains without tax will just be $112.50. That is a good one. Okay, you saw it from here. Uh-huh. Now I know. Anyway, that was uh, okay. It's okay. At least you are saying something. Okay, so that is it. These were listed shares, though, therefore we don't have capital gains there. We just have capital gains without index, which is CGWT of 1%. Okay, now we have this one. On 3rd June 2014, Michael sold 20,000 shares of his shares in Tit for Tat Private Limited for 24,000. He had purchased 10,000 shares in Tit for Tat on 1 May 2009 for 15,000. In 2009, Tit for Tat made a rights issue of one share for two held. Michael exercised his rights in full and paid 60 cents for each. Calculate the best cost of the shares at the date of disposal. Then calculate Michael's CGT liability on refund. Okay, so you are calculating this one. I'm giving you 5 minutes, so it's 23. By 28, you'll be done. Kuna wuce. Time up. What do we have? No. So who was it? Who was that person? What do you mean by he? Like the papa was suffering from his autism. When was in there? In my room. No. Oh. It was on someone else. I don't know. Hmm? Of course. Okay. Who should I pick? Okay, let me see who is attending. Oh, Alex, what do you have? Hmm? Hmm? Oh, you are still calculating. Okay. Okay, so the first step was to calculate the number of the rights issue shares, and we are told that it was 1 for 2. So if you say 1/2 multiplied by 20, I think that should be oh, by 30, yes, yes, by 30. So that will be 15,000. Then now the total shares will be the 30 original plus 15 of the rights issue. The cost of that issue was 60 cents, isn't? We acquired them for, we paid 6 cents, then multiplied by 15, the cost was 9,000. So originally we had acquired these ones for 15,000, the 30,000 shares plus the 9,000, the cost of the rights issue shares, then the total cost will be 24,000. So that was our requirement. Calculate the base cost of the shares at the date of disposal. So that will be 25,000, 24,000 total, or we divide by 45,000, the number of shares, to find the base cost per share. Okay. Uh, what about the cost of the shares sold? You would just say the 20,000 shares that were sold over 45,000, the total shares multiplied by the 24,000, the base cost that we calculated earlier. Then inflation allowance, just say 2.5% multiplied by the 10.67 multiplied by 6 years. 6 years, we are obviously counting from the date of the original shares. So the original shares were acquired in 2009, 2009, 2010, 2011, 2012, 13, 14. That is 6 years. Then we now have so we have cost of shares sold, the 10667 plus the inflation allowance to form our base costs. You remember how we're calculating base cost on those other yesterday. Okay, so this is how you calculate it. Gross capital amount 24,000. Okay, we sold our main shares. We sold 20,000 shares at 24 for 24,000 in total. So that is our gross capital amount. Then we say less the base cost that we calculated, which is the 12 point something. Then we have a capital gain. Then we calculate our capital gains tax at 20%. Then we deduct capital gains without in tax. Obviously, it will be 5%. 5% of the 24,000. What is 5% of 24,000? 5% of 24,000. Okay, so I think we covered. Can you mute your mic? I'm hearing some funny sounds, maybe because I'm putting on headphones. Anyway, I was saying, I said when we covered capital gains without taxes, and we said okay, the capital gains without tax is 5%, isn't? And by the way, did we cover capital gains without tax? We did. So it's 5%. So we know how withhold tax works. They are withheld at source. So before, let's say you sell your specified asset to me. So before I give you your money, the 24,000, I withhold 5% and pay that money to Zimra. So when you are now calculating your CGT and you've calculated CGT to say, okay, on the total gross capital amount, my CGT is 2,347. Then you can't pay this one because the 1.2 was already withheld by the buyer. So you have to pay the net. So we have to deduct the capital gains without tax from the capital gains tax that you would have computed. So that's why you see in some in the case of listed shares, we say okay, you don't have the burden to do the capital gains computation because the withhold tax is final. The 1% is final. We don't do the computation so that we can determine the capital gains payable on the on the sale that is of listed shares because the withholding tax is final. But in this case, it was not final because the shares were not listed. That is why we had to do this computation, and then we deduct capital gains without tax. Okay. Mhm. Okay. So yes, we treat them like an improvement, but the exception is that inflation allowance is calculated from the date of the original shares. I okay. I think I actually said that in one of the slides. Okay. Now let's go to the no, it's not a monster, but sometimes it's to get confusing. Section 13, where the asset is damaged or it is destroyed in fire with cyclone die or whatever the pandemic. What are the CGT consequences or implications? When a specified asset is destroyed or damaged, it is deemed sold for a value of the compensation received. We covered this when we were doing deemed disposals and provided the compensation is greater than the base cost, allow reduction of the asset. Okay, so this is very important. That's why it was underlined. We deem that there is a disposal. Let's say your asset is destroyed in fire or in a cyclone, and the insurance pays you something. So we say it is a deemed disposal. Zimra will say you actually have disposed something. But the question is at what value? And the value will be the compensation received. But in the case that the compensation received is actually less than the base cost, let's remember the base cost. The base cost is not just the cost of the asset, it's the cost of the asset. Who is joining this late? Amanaga. Okay. So remember what constitutes the base cost. The base cost is a combination of the cost of the asset itself, the inflation allowance, and improvements, inflation allowance on the improvements, and also any selling expenses. Everything that is an allowable deduction is forms the base cost. So after receiving the compensation, you are going to compare the compensation to the base cost. And if the compensation is less than the base cost, then we don't have a disposal there. So where the compensation does not exceed the base cost of the destroyed asset, there shall be no sale. Where the taxpayer can satisfy the Commissioner General that he will use the whole or part of the proceeds that exceed the base cost on the purchase or construction of another specified asset or replacement of the damaged asset within 2 tax years from the date such asset was damaged or destroyed, then such proceeds shall not be deemed proceeds of sale. Okay. Sometimes you say, okay, my asset was damaged and I got this insurance, but I'm going to use this money to acquire another asset or to construct or to replace the asset within the next 2 years from the date when the asset was destroyed. Then we say they shall not be deemed proceeds. Then we don't have any deemed proceeds there. Thus, no capital gains tax arise on such amounts to the extent to which the compensation is expended. So we actually treat it as the way we're treating rollover reliefs that yesterday. If let's say the compensation is 500, but you spend 300, then we say there is no capital gain that is arising on the 300. That's why we say it to the extent to which the compensation is expended. However, a capital gains tax liability arises on any unused portion of the compensation. The cost of replacing or of the repairs effected as a result of damages or destructions would not be allowed as a deduction when the asset is finally sold. Okay. The cost of the replacement effected as a result of damages or destructions would not be allowed as a deduction when the asset is finally sold. This is so because the taxpayer did not incur the cost of the repairs. Okay. In terms of section 13.2, if the amount recovered from an insurance company does not cover the base cost, that is the law of deduction, then they shall not be deemed to have been sold. Thus, no capital gains arises. In that case, so if that happens, what is the implication then in the future? So in that case, the compensation would be used to reduce the base cost of the replaced asset. That is the treatment. We are going to take the compensation, we deduct it from the, let's say the compensation was 400, then we construct another asset for 600. That means the cost of the new asset will not be 600, it will be 200. We are going to use the proceeds from insurance to reduce the cost of the replaced asset. That is the implication there. Then, where no compensation is received for a damaged asset, the restoration costs are allowable deductions in the calculation of the capital gain when the replaced asset is eventually sold. So where no compensation received for a damaged asset, the restoration costs are allowed reduction in the calculation of the capital gains tax when the replaced asset is eventually sold. Of course, that is straightforward. Okay. Uh, this is just let me see what is this slide is saying. Looks like saying nothing. Capital gains tax computation for the year 2020. What is that? We need to move this slide no longer in 2010. It is now 2021. 7 years. Okay. What are these slides doing? So we have covered much on CGT. Do we have any questions before we finish it off? Okay. Section 13 again, the portion of the compensation received for a damaged asset that is not used to repair or replace the asset within two taxes. We covered this slide. Compensation. I want just to see if we have an example so that we can just. Okay, so this is an illustration of whatever that we're saying. So let's say the asset uh, was costing 2,000 when we acquired it, then it was damaged. Then we receive 6,000 as compensation. Then after receiving 6,000 as compensation, uh, let's say we have three scenarios. We expend 2,000. What will be the treatment? What if we expend 500? What will be the treatment? What if we expend 6,000? What will be the treatment? Okay, so let's start with a case where we had to expend only 2,000. So as you can see, if you say 6 minus 2, the unexpended amount will be 4,000. So the deemed sale will be 4,000, which is the expended amount. Then we raise a CGT assessment based on the unexpended amount. Then raise CGT assessment in the year of eventual sale cost being 4,000. Then what if it was 500? The unexpended amount is 500, and this is less than the base cost. So therefore, there is no sale. Reduce cost of 2,000 by amount not expended. The result is the cost on eventual sale. Then what about if we receive 6,000, then we expend 6,000? Unexpended amount is new, therefore there's no disposal. The no reduction in cost, disregard the compensation, raise CGT assessment on the eventual sale in the normal way. This slide is very important. You have to visit it again and again. Sometimes, normally, students they don't get this. This slide is rich, and these examples are. If you can just grasp the concept that are being said there, you will be good to go. You will be graduates. Anyway, uh, let me try to save my recording. I just hope it works today. Now 39 minutes.